Taxes can be one of the biggest drains on your wealth. But the good news is there are ways to legally avoid them on certain types of income. As a certified financial planner, I've helped countless families figure this out. And today I'm going to show you 5 types of income that the IRS doesn't tax. Now, these strategies aren't just for people with loads of money either. There are tools anyone can use to keep more of your hard-earned dollars. So in this video, I'll break them down for you, explain how they work, and share tips to help you use them in your own planning. So let's dive into the first type of income that the IRS doesn't tax, which is Roth IRA withdrawals. The Roth IRA is one of the most powerful tools for creating tax-free income. And here's how it works. As long as you are at least 59.5 and have held the account for at least 5 years, every dollar you withdraw is completely tax-free, including your contributions, the earnings, and the growth. So let me give you an example. Say you contributed $50,000 to your Roth IRA, and over time it grew to $500,000. That's $450K in earnings, and you can withdraw all of it tax-free. This makes the Roth IRA one of the most effective ways to generate reliable, tax-free income in retirement. Now, the benefits go beyond just avoiding taxes on the withdrawals. When you manage your income streams strategically, you can keep your taxable income low, which might also help reduce taxes on your Social Security benefits and avoid Medicare surcharges that could kick in at higher income levels. This is how smart planning with a Roth IRA can boost your overall tax efficiency and protect more of your wealth. Now, while the Roth IRA is designed for retirement savings, it has a unique advantage over other tax-advantaged accounts, which is flexibility. Unlike a 401k or traditional IRA, with a Roth IRA, you can withdraw your contributions, which is just the amount you put in, at any time without taxes or penalties. So for example, if you have $50,000 in a Roth IRA, and $20,000 of that is your contributions, you can withdraw that 20 grand completely tax and penalty free. This makes the Roth IRA an excellent last resort safety net in case of an emergency. Now, here's my warning though. I recommend avoiding this unless you're truly in a pinch. Ideally, you should have an emergency fund for unexpected expenses because tapping into your Roth IRA early can completely destroy its growth potential and set you back years missing out on compound interest. So just be careful and don't abuse it. Next up is the Health Savings Account, or HSA. And this is one of the most tax efficient accounts available because it's triple tax advantaged, meaning contributions are tax deductible when you put money into the account, the money grows tax free inside the account, and withdrawals for qualified medical expenses are also completely tax-free. Now, the only downside to this is you need to be enrolled in a high deductible health plan. You can't just go online and open an HSA without having a qualified health plan in place. But once you're covered by a high deductible health plan, you can open an HSA and start contributing to get your tax deduction. Now, here's where I see a lot of people make mistakes. They go and open up an account, start contributing, but never actually invest the money inside the HSA. The funds sit there in cash, missing out on the chance to grow and compound tax free. Here's what I see happen. I worked with someone who had been contributing to their HSA for years, reviewed their account, and saw the money had never been invested. Their provider required a minimum balance of $2,000 before they could start investing. And since they were only contributing, a few $100s a month, they set it to autopilot and completely forgot to follow up on it. This is more common than you think, and it's an easy mistake to avoid. Many HSA providers let you start investing once your balance hits $1,000. So make sure to check the rules for your account and don't leave that money sitting there doing nothing when it could be growing tax-free. Now let's talk about qualified dividends and long-term capital gains, 2 sources of income that can be completely tax-free if your taxable income falls below certain thresholds. Now, for the right person, this can be a fantastic way to generate tax-free income. Here's how it works. In 2025, if you are a married couple filing jointly and your taxable income is less than $96,700, your long-term capital gains and qualified dividend income up to that point are taxed at 0%, completely tax-free. It gets even better when you factor in the standard deduction, which reduces your taxable income by a fixed amount. So when you use the standard deduction, it actually allows you to make more than $96,700 because using the standard deduction will bring the total amount back down in the 0% tax category. Now for 2025, the standard deduction is $30,000 for married couples filing jointly. So this means you can earn up to $126,700 in a year, which is the 96.7 plus the 30K standard deduction, and still pay no taxes on your long-term capital gains or qualified dividends. This is where smart tax planning can make a huge difference. By strategically managing your income sources, like pulling from investment accounts, dividends, or capital gains, you can keep your tax bill incredibly low or even eliminate it altogether. Another powerful source of tax-free income comes from downsizing or tapping into the equity in your home. So let's say you purchased a home in Texas for 500 grand 10 years ago, and today it's worth $1 million. That means you have $500,000 in capital gains. If you're married and file jointly, you can exclude up to $500K of those gains from taxes when you sell your home and take the entire profit on the sale tax-free. And if you're single, you can exclude up to $250,000 of those gains. Just know, in order to take advantage of this, you must have lived in the home for at least 2 of the last 5 years before the sale. And the exclusion applies only to your primary residence. So if you have vacation homes or rental properties, you wouldn't be able to use this on those. You can also increase the amount of tax-free gain by adjusting your home's basis. And to keep it simple, basis is just the amount you paid for the home plus any improvements you've made over time. So for example, if you bought your home for $500,000, then spent 50 grand on a kitchen renovation and maybe $100,000 adding a new room, your new basis would be $650,000. So if you sell the house for $1 million, your taxable gain would only be $350,000, meaning you can pull even more money out of the sale completely tax-free. So if your home has appreciated significantly over the years and you're planning to downsize or move to a state with a lower cost of living, this can be an excellent way to generate tax-free income. Just make sure to keep detailed records of any major home improvements, as they will significantly help reduce your taxable gain and help you keep more of your home's value. All right, now that you know about some of these tax moves, you might be thinking about ways to maximize your financial freedom. And one of the biggest questions I hear from families is, should I pay off my mortgage early or invest for my future? And it's a decision that can have a huge impact on your goals. So in this video, I break it all down for you. If you're serious about building wealth while staying smart with your money, click on the video right here, and I'll see you over there.